As a bank that focuses on business, we work with business leaders all day, every day. We have a front row seat to what's working and what has potential. The First Business Bank podcast is dedicated to sharing insights to help you work better, smarter, and faster to achieve your goals. Let's get into the show.
Hello, I'm Mark Meloy, CEO of First Business Bank. I'd like to welcome you to another episode of the First Business Bank podcast. Today, we are discussing the upcoming elimination of LIBOR as a base rate and what does that mean for borrowers and banks. I'm joined by two colleagues today, and I'm going to have each of them introduce themselves before we get started. Ed?
Sure. Thanks, Mark. Ed Sloane. I'm the Chief Financial Officer of First Business Financial Services, and I've been with the company for approximately 5 years, about 35 years in banking in total.
Thanks, Ed. Bill?
Thanks, Mark. Bill Uelmen. I'm Director of Treasury of First Business Bank. Been with the bank for just under 5 years and been in banking for over 30 years.
Good. Well, let's get started. Ed, I'll direct the first question to you. What is LIBOR? What exactly is the topic we're talking about today? What's LIBOR?
Sure. Thanks. LIBOR stands for London Interbank Offered Rate. It's a benchmark or a reference rate or an index. You can use those terms synonymously here. And it's a rate that banks use to lend to one another. It's calculated and published on a daily basis through the Intercontinental Exchange. And it's a very common index for a wide range of financial products. It's widely accepted across not only the United States, but worldwide. It has a significant global market, about 350 trillion of outstanding business is tied to LIBOR and at different maturities. So it's not just an overnight rate. It's a combination of 5 different currencies, 7 maturities, 35 different LIBOR rates that are calculated and published each day. So you can just imagine, Mark, the massive undertaking that we're talking about here to eliminate LIBOR and move to an alternative index. So significant market presence.
Thanks. I know that LIBOR's been around for a while. When I got in banking 35 years ago, it was really prime. And ultimately, over the years, LIBOR became an alternative base rate. It's been around for an extended period of time, as has been mentioned. But Bill, what's happening? Why is the change being made to transition away from LIBOR?
Well, LIBOR goes back, almost 50 years, like you had mentioned, and LIBOR started to be used in the markets as it was more of a market-driven rate. So banks in the 70s started pricing euro-dollar deposits and off of different currencies and things, and really sophisticated borrowers started using this for interest rate derivatives, swaps, commercial loans, residential loans, investment securities. So it really became really widely used. Then in the 80s, the regulators realized how much activity was really happening with LIBOR, and they started to put in the different term structures that Ed had mentioned. So the different terms, the different settlement dates really put a lot of structure behind it. And it created a lot of standardization behind LIBOR and that structure. And as you said, really in the US, mostly, prime was the primary index that was being used. And it's really been more in the last 15, 20 years where LIBOR has really taken over that index in financial markets.
So what products, as we're talking about it today, and we have many clients that are going to listen in on this conversation ultimately, what types of products and instruments does it impact for what would be more commonly used by our clients and prospects?
Sure. So banks really use LIBOR in many parts of the balance sheet. They use it for their deposit pricing, commercial and residential loan pricing, like I mentioned earlier, corporate debt offerings, and then interest rate derivatives and things to protect against interest rate risk. So really at First Business, we primarily use LIBOR for our floating rate loans, corporate loans on our balance sheet. We do some, derivatives, cash flow hedges and things to lock in our fixed funding. And we do use interest rate swaps for a lot of our loan clients who are really looking for a fixed rate alternative. So we can offer a floating rate loan, swap it to fixed, and then swap it back to floating rate on the bank's balance sheet, which we prefer, and do that through a back-to-back swap program. So we use the LIBOR really fairly extensively, and it's obviously, as Ed had mentioned, a very large market, and again, our balance sheet has significant exposure to LIBOR.
Mm-hmm. So Ed, does this impact all banks and other lenders alike, and businesses and consumers alike?
Yeah, all the above, Mark. It's as we've been saying here, LIBOR is a very widely used index, so it impacts a variety of products. I know, Bill, you mentioned some, not only in the commercial space, but also in the retail credit, various credit lines, home equity lines, credit cards, student loans, have a tie into LIBOR. And then on the deposit side, money market deposit accounts, it's very prevalent in the banking industry, and even CDs to take advantage of some of the maturity structure that's out there with LIBOR. So it's a very popular index. I've been citing some of the breadth of LIBOR and 1.3 trillion in consumer loans that have a rate tied to LIBOR. So it just gives you an idea of the relative size of just in the consumer loan business how much LIBOR is used. So when you think about it in terms of the financial institution side, smaller financial institutions tend to be a little more plain vanilla with their lending products in particular, and those would tend to go more towards a prime rate and a fixed rate type loan. So you don't get into derivative structures, swaps, and things like that so much in the smaller institutions. But take First Business as an example, Mark, and you see a larger financial institution that have larger, more complex business and commercial type customers. They're looking for different types of structures. And so when you break that down in our balance sheet, you're probably talking about 50% of our loan portfolio is fixed rate, and the other 50% is variable. And most of those variable rate loans are tied to LIBOR. We do have some that are prime based as well, but a good many of them are LIBOR based. And then those that are LIBOR, will there are a number of those that will have a swap arrangement or a derivative type arrangement around those. So to Bill's comment earlier about swapping a variable rate for a fixed rate on the client side, and then the bank takes the variable position. From a client perspective, this improves where they are in terms of their interest rate risk. We're in a low interest rate environment. They can lock in that fixed rate, and then also take advantage of some favorable pricing around that derivative. So that's been the most common use.
Mm-hmm. So LIBOR is going to go away. Bill, I'll direct this question to you.
Okay.
So what are banks considering as a replacement index to LIBOR?
Sure. So I guess a little history too, going back previously, the reason why we're going through this process is that LIBOR turned out to be more of a rate that banks were setting for their deposit cost. And back into right around the Great Recession and subsequent years after that, it was found that many of the banks were manipulating the rate in their favor. So doing transactions and trades and things that were linked to LIBOR. So what happened then is regulators created a committee to create a new index, or have a replacement index for LIBOR. And this committee is ARRC, A-R-R-C, which is Alternative Reference Rate Committee. So June of 2017, the ARRC committee recommended choosing SOFR as the overnight funding rate, which is secured overnight funding rate. The Federal Reserve of New York calculates the average Treasury repurchase agreement rate on a nightly basis and posts that as an average rate for SOFR. So it's considered more of a secured rate and different than a prime rate or Fed funds rate, which is more of a managed rate. So with SOFR, the derivative market is starting to develop. So that, again, that's currently a fairly new market, and they're starting to add transactions on a daily basis. First Business Bank, we're likely to follow what larger banks do in choosing SOFR as our replacement index. Right now, it does look like that will be the index that we will choose, but again, the larger market makers will determine that. And LIBOR will go away. So one of the things that we do have to do with this exercise is realize that the LIBOR rate will no longer be posted after December 31st, 2021. And it's possible that the rate would be sunsetted prior to that date. So we need to make sure that we have things in place to replace LIBOR with a new replacement index.
Yeah, let me add to that for a second, Bill, if I could. Yeah, so as Bill indicated, it's not clear at this point whether or not SOFR is going to be the replacement index. Market participants, large banks will make that determination likely as we move towards mid-2021. But until then, very important that banks, and this is what you were keying in on, Bill, that banks really start to gear up for that transition. How are they doing that? Well, we're looking at our new loan contracts, and so any new loans that are being added, we make sure that the contract has a language in it that addresses an alternative rate index. Not a specific index at this point, but at least that there is an alternative rate index that's likely to occur and be there as a replacement for LIBOR. We call that adding fallback language into the document. And the other thing that we need to be cognizant of are those existing contracts, the ones with our current clients that doesn't happen through a new contract, but we need to actually physically go in there and talk to our clients and explain to them what we need to do and to modify that contract to also include that fallback or alternative index language. So that's a big undertaking. When you think about the size of the portfolio that I was talking about here, 50% variable rate, we have a lot of LIBOR-based loans that are out there and new ones that are being added. And so we need to be on top of this from a contract perspective to make sure that we have at least allowed ourselves the opportunity to make that rate change, so that when the new rate is changed, then we can really expedite the process.
To be clear on that, would be basically an addendum. We'd need a borrower, if they don't have the fallback language in it now, in other words, the seamless transition to an alternative base rate, it would basically be a 1 or a 2-page type of an addendum that we would attach to the note or make part of the note by reference?
Yep. Precisely. I think banks originally started out by saying, okay, we need to go into the original contract and make a change. But now we are working with our legal team to put together more of a standardized addendum, so we don't have to go into the original contract and in essence create a new contract or agreement, but instead we can just have, like you had suggested, Mark, a 1 or a 2-page addendum to that. That'll be a much more efficient process for not only us but for the client.
Okay, good. Bill, you touched on this a little bit, but what are the pros and cons to a replacement rate for banks and really for the client borrower?
Sure. Well, the pros really is that SOFR is a market-driven rate. So going back to LIBOR, where banks are setting a rate on a daily basis, there's no transaction that's related to that pricing. It's just the bank pricing their deposits for the day. Where SOFR, again, is the average of all the Treasury repurchase agreement transactions for the day. And there's thousands of transactions, maybe tens of thousands of transactions every day. So it's very, very difficult to manipulate compared to what LIBOR was. So that's one of the key positives. The negatives, of course, that we need to learn a new index, right? We just started getting comfortable, I guess, as we said, at the latter half of the last few years or last 15 years. And now we have to learn the SOFR index. So I think there'll be a little, learning curve essentially for the market. There's also been some volatility between SOFR and LIBOR. So in times of liquidity needs, we've seen the two indexes differ a little bit over the last 2.5 years. The difference, I guess, is averaged out over time. So again, it's been small, but there has been a variable between the two. And right now, SOFR is a relatively new market. So there isn't a term structure established like they do for LIBOR, but we do feel that it is being developed and it will be in place, prior to the end of next year. The market for SOFR is probably about half what LIBOR is right now, but we do anticipate that obviously to increase over time. And then lastly, really more operational for First Business Bank, some of the loan systems need to be updated to be able to come up and calculate the SOFR rate, which is more of a compounded look-back rate versus LIBOR being at a forward-looking rate. So a few operational issues on our end that we have to go through as well.
Okay. Yes, tell me if I'm right on this, but as I think about sort of the market evolution to LIBOR becoming over the last 20, 25 years, as you mentioned, Bill, sort of more commonly used by middle market type borrowers, was the compelling part of it was a market driven rate as opposed to prime, which is really a market managed rate, right? I mean, it's kind of set at the Fed level and with some arbitrary decision making behind it. But it's kind of evolved away from that, as you described, in terms of what happened through regulators' oversight, to now SOFR, as an example, is really, in its purest sense, is really a market-driven rate. So it's kind of getting back to what the original intent and purpose was, with the then growing popularity of LIBOR versus prime, as an example. Is that a fair statement?
Yeah, it definitely is. And as you mentioned, LIBOR does have a bit of a credit component built into it because it's the interbank lending rate. So banks have a credit. They're very strong credits, but we know banks can fail. So they build a credit component into that pricing. SOFR is a secured rate because the overnight advances and borrowings are secured by U.S. government securities. So they're 100% guaranteed. So there's a difference between the two because of the credit difference.
Got it. Ed, does this change away from LIBOR mean extra risk or different risk to businesses or borrowers?
No, not really. I think with the initial rate under the new index, will be the same rate as the same current rate as what's being provided under LIBOR. While the rates will remain the same, it's really the underlying index, as Bill was describing, that changes. SOFR is a little bit different rate than LIBOR, so that spread between the index and the rate being offered is where the variation occurs. The thing that remains to be seen, as Bill pointed out, is some variability. If we do go to SOFR, some variability between the way SOFR reacts to changes in interest rates versus LIBOR, and that's where you could see some risk, in particular in the short term, but over a period of time. And I think as that market continues to build for SOFR, you'll see those two rates act pretty similar. Would you agree with that, Bill?
Yeah, I would. And I guess I can give a little bit of history right now. The last 2.5 years, LIBOR and SOFR had differed by about 11.5 basis points when looking at 1 month LIBOR, which is our primary index that we use on our balance sheet. So LIBOR has been 11.5 basis points higher than SOFR. So we would need to adjust the index or the credit spread to make sure, again, it's apples to apples and that the fixed rate, calculation or the floating rate calculation is really the same. So it really doesn't, the change of this index doesn't benefit First Business Bank. It doesn't hurt the clients. Net result should be exactly the same as we are with LIBOR.
Good. We've touched on some of this already, but what is First Business Bank doing to prepare for the transition away from LIBOR? And what's that timeline look like, Ed? Yeah,
so we have a transition team that's together on it. Mark's on this. Bill, myself, we have a couple other folks from senior management that round out the transition team. Participants in the process go beyond just the transition team itself. Obviously, the client's impacted, but also relationship managers, the operations group, loan operations in particular, and members of senior management are involved at certain points in the process. So there's a big cross section of first business officers, managers that make up the overall process here. The timeline, carries through what we've been talking about, Mark. Out through 2021 is the likely time frame around this, and at the end of 2021 is where LIBOR is expected to be discontinued. We'll obviously be ramping up to that by doing a number of things internally and with the client as we move through the next few quarters. On the client side, I mentioned this a little bit. We actually started back in March of 2019 to adjust new loan contracts for language that relates to the alternative rate index, what I was talking about before. So it could be SOFR, it could be another index that could end up being used. So again, we started that process, well over a year ago. And now in the fourth quarter of this year, we're starting to look at the existing client loan agreements to the point that you made earlier, Mark, considering an addendum that we could attach to the loan agreement, and that would have the modifying or fallback language in it. So, that's something that's going to be going on here in the fourth quarter into the second quarter of next year. It'll take some time. We have a number of loans that need to be addressed. Interest rate swap agreements that Bill mentioned earlier, those have a tie into LIBOR and will require some modifications as well. Some of the modifying language that I mentioned earlier. That all these things are important to really expedite the process. And then also from a regulatory standpoint, we have guidance that comes out on a regular basis from our regulators, the Federal Reserve, the FDIC, indicating the need for banks to do this type of planning and adjustments to their internal loan agreements, et cetera. We would expect then the final communication associated with the actual replacement index to happen later in 2021, and that happens upon the discontinuance of LIBOR. That's on the client side, so lots of back and forth with the client to address some of the modifying language that I'm talking about here. As it relates internally to the process, we initially created an inventory of products that are tied to LIBOR. We're reviewing operating systems for the rate calculation that Bill mentioned earlier, making sure that a different index can be accepted in place of LIBOR, looking at third-party vendor agreements, and then various risk management considerations, whether that's on the regulatory front, legal, various compliance and disclosure type issues to address it. So it is a big undertaking. A lot of things being done with the client as well as internally through our transition team.
Yeah, I think that's a really, really good synopsis of actions in the plan. But I think suffice it to say, for that LIBOR-based borrower, if there's an addendum that needs to be executed, there will be an outreach from First Business Bank to them to get this going. We don't expect them to scour through their loan documents to make that determination on their own, but that we will proactively be reaching out. And much of what the purpose of this conversation today is, and other communication is really the idea of education and information to help try and answer questions that may come up that people are going to hear in conversations, they're going to hear on the news, they're going to see in the Wall Street Journal or what have you, to know that we're moving forward on their behalf in this way. Is there something else you wanted to add, Ed?
Yeah. So, Mark, what I would add to that is that we do have this podcast. Of course, we have a Q&A that's available on our website, and we're also communicating directly with our clients that have a LIBOR-based product. and talking to them about the impact of the transition, modifications needed to existing loan agreements, as we've been talking about, and then also the timing of the change. So that's we're reaching the client a number of different ways.
Thanks, Ed. Bill, anything to add to the conversation?
Nothing else here. Again, a lot of this is in our court, and we'll be in communication. We'll be reaching out to clients here very shortly here in the first quarter. And really our plan is to have everything ready in place by middle of next year, so that by the end of the year we are ready to go with the transition.
Good, thanks. Well, I want to thank both of you, Ed and Bill, for sharing your thoughts about the pending elimination of LIBOR as a base rate. And to all of you, our audience, thanks for listening to our conversation. And as we move closer on the calendar to the eventual elimination of LIBOR, you will hear more and more about it from First Business Bank and from your relationship manager. There are still a few of our clients with LIBOR-based notes that need to execute the addendum we talked about to ensure a smooth transition to the new base rate. That will all be wrapped up in the next few months, so those conversations will be forthcoming relatively soon. For most others, your documents are already ready to go, and the only action remaining is the finalizing of the replacement rate that First Business Bank will determine at future time period. And of course, for those of you listening that don't have a LIBOR-based variable rate note, you learned a lot about LIBOR loans and the pending change, but you don't have to do anything at all. We hope we enlightened you a little bit, though, in that part of the conversation. So let us know if there are other topics or information you'd like to learn more about, and join us the next time on the First Business Bank podcast.
If you want more content like what you just heard delivered straight to your inbox, go to firstbusinessbankpodcast.com. And if you haven't already, make sure to subscribe to the First Business Bank podcast wherever you listen to podcasts. If you're listening on Apple Podcasts, please leave a quick rating of the show. Thanks so much for listening. First Business Bank, member FDIC.